If you have more than $25,000 sitting in a single bank account right now, three separate financial forces are working against you simultaneously. The first two are quiet. They're reducing your purchasing power every single month without making a sound. Most retirees don't notice them until they do the math. The third one is different. The third one can get your account flagged by a federal compliance algorithm, trigger a report to a government database you've never heard of, freeze access to your own money without notice, and, in documented cases across the United States, result in the seizure of funds that were completely, legally yours. Your bank will not warn you about any of this. Your bank profits when your savings sit idle. The more money stays in your account earning almost nothing, the more they lend it out at rates 10 times what they're paying you. They have no financial incentive to suggest you move it. In the next 18 minutes, I'm going to show you the exact threshold the IRS uses to watch your account, the second reporting trigger that has no dollar floor at all, the 7 specific behaviors that automatically flag your account for federal review, and the 5 accounts financial planners actually use to protect their own money. Accounts most retirees have never been told exist. I'm Ellis Rowe, an enrolled agent licensed by the federal government to represent taxpayers before the IRS. What you're about to hear is the same framework I walk every new retirement client through. There is no version of this conversation your bank will ever initiate. So let's start. This video is for educational purposes only and does not constitute legal, tax, or financial advice. Consult a qualified professional for guidance specific to your situation. Before I get into the mechanics, I want to tell you about a client. I'll call him Robert. Robert is 68 years old, a retired union electrician from outside Columbus, Ohio. He worked for the same company for 34 years, earned a pension, paid off his house, and maintained a savings account at the same bank he'd used since he was 19. Balance, roughly $140,000. Robert wasn't wealthy. Robert was disciplined. Last winter, Robert decided to help his daughter buy her first house in Florida. The down payment was $22,000. He had been saving toward exactly this kind of moment for decades. On a Tuesday morning, he walked into his branch and requested a cashier's check made out to the title company in Tampa. The teller took his withdrawal slip, looked at the screen, asked Robert to please take a seat. A branch manager came out, led Robert into a private office, and proceeded to ask him a series of questions. Why did he need the money? Where was it going? Had anyone instructed him to make this withdrawal? Had he received any phone calls, emails, or messages asking him to transfer funds? Had he met anyone new online in the past 6 months? A perfectly capable 68-year-old man was being interrogated by his own bank about helping his own daughter buy a house with his own money. The branch manager informed Robert the withdrawal would be subject to a 48-hour compliance review. Robert drove to a gas station payphone to call his daughter and explain that the closing would need to be postponed. When the cashier's check finally cleared 2 days later, Robert assumed the matter was finished. It was not. 3 weeks later, a letter arrived from the bank notifying Robert that a suspicious activity report had been filed on his withdrawal with the Financial Crimes Enforcement Network. That report now lives in a federal database that will be cross-referenced against every financial transaction Robert makes for the next 5 years. Robert did nothing wrong. He was a retired electrician who wanted to help his daughter buy a home. This is what the system is doing to ordinary American retirees every single day. And every flag, every freeze, every federal report in cases like Robert's traces back to one decision: keeping too much money concentrated in a single bank account. That is the only thing Robert did. And it's the thing I'm going to show you how to undo. Let's start with the rule most people have heard of, and almost nobody actually understands. Under the Bank Secrecy Act, any cash deposit, withdrawal, or transfer exceeding $10,000 at a federally insured financial institution in a single business day triggers a mandatory currency transaction report filed directly with the Financial Crimes Enforcement Network, FinCEN. That report contains your full legal name, social security number, date of birth, home address, the exact amount of the transaction, the type of transaction, and the timestamp down to the minute. It's filed within 15 days. You will never receive a copy. The bank is legally prohibited from telling you it was filed. The report enters a federal database, the Bank Secrecy Act database, shared across FinCEN, the IRS Criminal Investigation Division, the Drug Enforcement Administration, the Department of Homeland Security, and approximately 400 other federal, state, and local agencies. Your name remains in that database for 5 years. Every subsequent financial transaction you make is automatically cross-referenced against your existing record. Unusual patterns get scored. High scores get flagged. Flagged accounts get reviewed by a human compliance officer. That is the system. Now here's where most people make the mistake that costs them. They hear $10,000 and assume that staying below it keeps them safe. It doesn't, because the $10,000 rule is not the rule that should concern you most. The more dangerous instrument is the Suspicious Activity Report, the SAR. And unlike the Currency Transaction Report, the SAR has no minimum dollar threshold. A SAR can be filed on a transaction of any size: $100, $500, $2,000. The decision to file is made entirely by the bank's internal compliance team based on whether a transaction fits a pattern their software classifies as unusual. The bank has 30 days from the activity to make that determination. The SAR goes into the same federal database as the Currency Transaction Report. You will never be notified that it was filed. You have no legal right to know it exists. And if a bank employee informs you that a SAR was filed on your account, that employee has committed a federal crime, tipping off, carrying up to 5 years in prison. That legal structure also explains why your bank files SARs aggressively. A bank that files a SAR incorrectly faces zero regulatory penalty. A bank that fails to file when it should have can be fined millions of dollars, and the compliance officers who missed it can lose their licenses permanently. The institutional math is straightforward. Freeze first, file first, ask questions later, if at all. Here are the 7 specific behaviors bank compliance software is actively monitoring for. Most retirees have triggered at least 3 of them in the past year without realizing it. Behavior. 1. A transaction that breaks your historical pattern. If you've averaged $500 in weekly withdrawals for a decade and you walk in one day requesting $8,000, the deviation gets flagged, regardless of the reason. The software doesn't evaluate intent. It evaluates variance. A grandmother who hasn't withdrawn more than $300 in 15 years pulling out $2,000 for family reunion airfare will generate a flag. The system doesn't know why. It doesn't need to. It only needs to see the departure from baseline. Behavior 2. Multiple transactions that collectively cross $10,000. 2 $5,000 deposits on consecutive days. 3 $4,000 deposits across a week. 4 $3,000 deposits over a month. The compliance software now tracks these patterns across rolling 90-day windows. This is what federal law calls structuring. And under Title 31, U.S. Code 5324, it's a federal felony carrying up to 5 years in prison and civil forfeiture of the full amount involved, even when every dollar of the underlying money is completely legitimate. I need to pause here because the structuring statute has destroyed the finances of hundreds of innocent Americans whose cases are part of the public record. Carol Hinders operated a family restaurant in Iowa for 38 years. She deposited cash below $10,000 regularly because her insurance policy limited on-premises cash holdings. The IRS seized her entire business account, $33,000 in operating capital, without filing a single criminal charge. It took 2 years of litigation and a pro bono public interest law firm to recover the money. Her restaurant closed permanently before the funds were returned. Lyndon McClellan, a convenience store operator in North Carolina, lost $17,000 to a structuring seizure, never charged with a crime. Andrew Clyde, a firearm retailer in Georgia, had $940,000 seized. Years of federal litigation followed before he recovered it. None of them were criminals. All of them were business owners who deposited cash in sub-$10,000 amounts for legitimate operational reasons. The pattern recognition flagged them. The money was taken through civil asset forfeiture, which does not require a criminal conviction. The government is not required to prove wrongdoing. You are required to prove you didn't. While you're proving it, your money is gone. Behavior 3. A wire transfer on an account that hasn't previously sent or received wires. The first outgoing wire from any account is treated as a high-risk event regardless of the amount. Compliance software flags it because wire transfer is the most common mechanism fraudsters use to drain accounts they're exploiting. The algorithm cannot distinguish between you wiring $3,000 to a contractor for a kitchen remodel and a scammer wiring $3,000 out of an elderly account holder's funds. It flags both. Behavior 4. Round number transactions near the $10,000 threshold. A withdrawal of exactly $9,000. A deposit of exactly $7,500. Compliance systems are specifically trained to identify round numbers just below $10,000 because that's the behavioral signature of someone attempting to evade the CTR requirement. The cruel irony, the very act of trying to be careful is what generates the flag. The compliance officer doesn't need to believe you did anything wrong. The algorithm just needs to see the pattern. Behavior 5. Account activity inconsistent with your known income profile. A retiree receiving Social Security depositing $12,000 from an undocumented source will be flagged, even if that $12,000 came from selling a vehicle or cashing an insurance policy. This is why large unexpected deposits should never hit your primary account without documentation prepared in advance. Sold a car? Keep the bill of sale and title transfer. Cashed an insurance policy? Keep the carrier statement and policy documents. Received an inheritance? Keep the executor's letter and probate documentation. When a compliance officer reviews the flag, those records are what prevent a SAR from being filed. Behavior. 6. Cash deposits made by a third party. If your adult child walks into your branch and deposits cash into your account on your behalf, the bank records it as a third-party deposit. Third-party cash deposits above a few $1,000s are reviewed almost automatically. The same scrutiny applies to deposits made at branches other than your home branch, deposits left in the overnight drop box, and transactions completed just before or after the bank's closing time. Any deviation from your normal deposit method gets scored. Behavior. 7. Transactions linked to flagged geographic regions, industries, or merchant categories. The compliance software maintains internal lists of countries, area codes, zip codes, and merchant categories that automatically receive elevated scrutiny. You don't need to be doing anything wrong. The flag is based on association, not conduct. A wire to a contractor in a state on the high-risk list. A deposit from a relative living abroad. A payment from a buyer whose address falls in a flagged zip code. None of these require wrongdoing. All of them can trigger a review. Stack all 7 of these against the $10,000 CTR threshold, and the picture becomes clear. The solution isn't learning how to navigate the line. The solution is to stop keeping enough money in a watched account to make any of this matter. The second force working against your bank balance has nothing to do with federal surveillance. It's simpler than that. It's arithmetic. In 2026, the average interest rate on a standard checking account is approximately 0.06%. On a regular savings account, roughly 0.40%. Both figures sit well below the current inflation rate of approximately 3%, which means every month your money stays in a conventional bank account, its purchasing power declines. Not because the dollars disappear. They don't. Because each dollar buys less than it did the month before. $50,000 sitting in a checking account earning effectively 0 against 3% annual inflation loses $1,500 in purchasing power over 12 months. You did nothing wrong. You made no bad decisions. You still lost. Meanwhile, that same bank is lending your deposited funds at rates between 7% and 12%. A bank holding $100 million in retiree deposits paying 0.40%, while lending that same money at 7% is generating approximately $6.6 million annually on money that doesn't belong to them. That is the business model. Your money sits idle. They deploy it. They collect the spread. You absorb the inflation loss. Your bank is not your financial partner. You are its lowest cost source of capital. The third risk requires only one number to understand: $250,000. That is the FDIC insurance limit per depositor, per insured bank, per ownership category. If you hold $300,000 at a single institution and that bank fails, $50,000 of your money is uninsured. There is no backstop. There is no appeal. In 2023, 3 of the largest bank failures in American history occurred within 10 weeks of each other. Silicon Valley Bank, First Republic, Signature Bank. The FDIC covered insured deposits. Uninsured balances were at risk. Many larger depositors were made whole as a political decision, but no law requires that to happen again. The next failure will not announce itself. Banks don't send advance notice. The doors close on a Friday afternoon and reopen Monday under different management, or don't reopen at all. The answer financial planners give their own clients is consistent. Keep 3 to 6 months of essential living expenses in a checking or high-yield savings account. For the median American retiree, that's roughly $15,000 to $25,000. Everything above that threshold belongs somewhere else, not because you can't afford to leave it, but because every dollar you leave there is being surveilled, eroded by inflation, and deployed by someone else to generate returns you'll never see. Here are the 5 places financial planners actually move excess savings. Pay close attention. This is the practical core of the video, and it's information almost no bank will volunteer. Account 1. A high-yield savings account at an online bank. Online banks, Ally, Marcus by Goldman Sachs, Discover, Capital One 360, Wealthfront, are currently paying between 3.5% and 4.5% on savings accounts that are fully FDIC insured up to $250,000. The money is liquid, transferable back to your checking account in 1 to 3 business days. No monthly fees, no minimum balance requirements. Opening an account takes approximately 10 minutes and requires only your social security number, driver's license, and your current bank's routing and account numbers. That's roughly 10 times what your local bank pays on the same deposit with identical federal insurance protection. Account 2. U.S. Treasury Bills. Treasury bills are short-term loans you extend directly to the federal government, purchasable in increments as small as $100 through treasurydirect.gov, operated by the U.S. Department of the Treasury. 4-week, 8-week, 13-week, and 26-week bills are currently paying between 4% and 4.5%, backed by the full faith and credit of the United States government. Interest on Treasury bills is exempt from state income tax, meaning if you live in California, New York, Oregon, or Hawaii, T-bills frequently outperform high-yield savings accounts on an after-tax basis. The most effective structure for retirees is a Treasury ladder. Stagger purchases so that a bill matures every few weeks. A basic ladder might hold $10,000 in 4-week bills, $10,000 in 8-week bills, $10,000 in 13-week bills, and $10,000 in 26-week bills, providing regular access to maturing cash while maintaining continuous yield. Account 3. Series 1. Savings Bonds. I-bonds are inflation-protected instruments whose interest rate adjusts every 6 months based on the official CPI. By design, they cannot lose purchasing power to inflation, making them the only investment in the United States legally guaranteed to keep pace with the cost of living regardless of broader economic conditions. Purchase limit: $10,000 per Social Security number per calendar year. A married couple filing jointly can acquire $20,000 annually. Minimum holding period: 12 months. Early redemption before 5 years forfeits the final 3 months of interest. After 5 years, no penalty applies. For inflation protection on money you won't need for at least a year, I-bonds are the cleanest instrument available to a retiree. Account 4. Brokered certificates of deposit. A standard bank CD locks your money at a single institution's rate. A brokered CD, purchased through a brokerage account at Fidelity, Schwab, or Vanguard, gives you access to CD rates from hundreds of banks simultaneously, currently ranging from 4.5% to 5%, all FDIC insured. The critical advantage: you can spread $1 million across 4 separate banks at $250,000 each, maintaining full FDIC coverage on the entire balance from a single brokerage account in roughly 15 minutes. Combine that with a maturity ladder spanning 3 months, 6 months, 1 year, 2 years, and 5 years, and you lock in current rates on the longer rungs while retaining liquidity on the shorter ones. Account 5. A money market mutual fund inside a brokerage account. Funds like the Vanguard Federal Money Market Fund, Fidelity Government Money Market Fund, and Schwab Value Advantage Money Fund hold short-term U.S. Treasury obligations and are currently paying between 4% and 5%. They are not FDIC insured, but they're backed by U.S. government debt, generally considered the safest asset class in the world. They're completely liquid. Funds transfer back to checking in 1 business day, with no holding periods, no withdrawal penalties, and no contribution caps. The optimal setup for most retirees: 1 to 2 months of expenses in your primary checking account, 3 to 4 months in a high-yield savings account at an online bank, 6 to 12 months in a laddered treasury bill portfolio, remaining emergency reserves in a brokered CD ladder spread across multiple institutions. That structure generates 3% to 5% on every dollar, keeps the entire balance either FDIC insured or government backed, removes you from the suspicious activity scoring algorithms at your local branch, and gives you graduated access to your money on a timeline ranging from 1 day to 12 months. Before making any of these moves, understand 3 scenarios that hit retirees hardest. 1. Required minimum distributions. Beginning at age 73, the IRS requires annual withdrawals from every traditional IRA and 401k you own. Those withdrawals are reported on Form 1099-R and arrive in your bank account as a single large deposit, often $15,000 to $40,000, that can trigger a SAR at your local branch if the bank has no record of expecting it. The fix: have your RMD deposited directly into a high-yield savings account rather than your primary checking, or schedule a branch meeting in advance and have the expected deposit noted in your customer profile. 2. Pension lump sum distributions. At retirement, some plans offer a single lump sum option in place of monthly payments. These distributions, sometimes exceeding $200,000, arrive as a single wire transfer and will be flagged for review the day they land, regardless of how verifiable the source. The fix: have the lump sum wired directly into a brokerage account. Brokerage accounts process large transactions routinely and don't run the same retail compliance algorithms as consumer checking accounts. 3. Survivor benefit deposits. When a spouse passes, the surviving partner often receives a life insurance payout, a Social Security retroactive payment, or a beneficiary distribution from a retirement account, sometimes all three, arriving during the most emotionally difficult period of their life. The fix. Before any anticipated large deposit arrives, open a separate account at a different institution. Route the incoming funds there. Your primary checking account remains unchanged. The original bank never sees the deposit, and therefore never has the opportunity to question it. You will never be directly notified that a suspicious activity report was filed, but you may observe indirect signals. A wire transfer that used to clear immediately now takes days. A routine withdrawal that triggers a manager consultation. A letter asking you to verify a transaction you've already confirmed. A request to visit the branch in person to discuss your account. None of these confirm a SAR was filed. All of them are consistent with one. The correct response is not to ask the bank directly. They cannot legally answer that question. The correct response is to begin moving funds out calmly, in normal amounts over a period of weeks into the accounts described above. By the time the next compliance review cycle runs, your remaining balance is small enough to generate no further interest from the algorithm. If you retain one figure from this video, make it this one: $25,000. That is the threshold above which keeping money in a conventional bank account simultaneously costs you more than it earns, exposes you to federal surveillance algorithms, and creates risks you have no reason to carry. Anything above $25,000 should be repositioned this month into the accounts I just described. Fully in your control, fully protected, and working for you rather than for the bank lending it. Here is your action for this week. Not this month, this week. Log into your bank account and look at your balance. If any single account holds more than $25,000, open one high-yield savings account at an online bank today. The process takes 10 minutes. Transfer everything above $25,000 into it. That single move on a typical retiree balance of $150,000 generates between $4,000 and $6,000 in additional interest annually, with no additional risk, no reduction in liquidity, and no exposure to the SAR triggering patterns at your local branch. Over a 25-year retirement, that one decision compounds into somewhere between $120,000 and $180,000 in additional income from money you already have, placed into accounts you simply didn't know existed. Subscribe if you want this kind of information consistently. No financial products, no affiliate pitches, just the specific mechanics of how the banking and tax systems actually operate and how to position yourself to benefit from both. Share this video with someone in your life who is over 60 and still keeps the majority of their savings in a single checking account. A parent, a sibling, a neighbor, someone from church. Robert's situation, the 48-hour hold, the compliance interrogation, the federal report filed on a completely legitimate transaction, is not unusual. It is the standard experience for retirees who keep concentrated balances at major banks without knowing what those balances trigger. One share from you could prevent all of that for someone who has no idea it's coming. The IRS is not going to call and explain any of this. Your bank is not going to schedule a meeting to walk you through it. The only person who can move the money is you.